Hello, everyone, and welcome. As always, it's great to have you here. Without further ado, it's my pleasure to introduce Kevin Davitt, head of NASDAQ's index option content. Kevin has spent years focused on options education with an index emphasis at CBOE Global Markets. And prior to this, he traded index, equity, and commodity futures and options as a market maker at a variety of well-known firms. And he is here today to share some of his expertise with us. So to our live audience, please type any questions you may have into the chat box. We may not have time to answer them, but if we do, we'll get to them at the end. With that all said, Kevin, I will hand the mic on over to you now. If you need anything at all, I'll be right here, but the floor's all yours.
Thank you so much, Charlotte, for that very kind introduction. And thank you to everyone who joined me this afternoon. I genuinely appreciate your time. It is one scarce commodity, and it says something about where our priorities at. So thank you. Over the next half hour or so, I have a fair bit of material to cover, and I'm going to do my best to get through it. But my goal isn't just to get through it, it's that the audience takes something away from this. So we will hopefully talk about the 8-month rally in equities that's been led by information technology. As an extension of that, the NASDAQ 100 performance over that time frame has outpaced the other major US equity indices by a considerable margin. In fairness, I work for NASDAQ. We are home to the NASDAQ 100 index options. And so perhaps I'm talking my book. On the flip side, we talked readily about the underperformance of the NDX in 2022. We're also going to discuss narratives generally and the way that they can sway our emotions, our thinkings, and in some cases, our positions. But that sort of big picture point brings me back to one of my most resolute beliefs about this business, about derivatives in general, about capital markets in general. You need a plan, and you ought to stick to your plan. So why do I keep bringing that up? Well, it's a decent lead-in to a disclaimer slide, which is requisite, but it's also very important. There's risk in every market, even 8-9 month long bull markets. Options have unique risks. The broad market and options can reprice risk in a hurry. In my experience, absent a plan, the tendency is that if and when like the backdrop changes, people typically bargain with themselves. They allow emotions to dictate the amount of risk that they assume, and they'll often they will often turn their short-term plays into longer-term positions. If there are any kind of regular listeners, they'll know that I'm a fan of analogies. And in this case, I think about the most successful coaches at any level of athletics. So like, do you think Bill Belichick, New England head coach for many years, the Patriots, has the same game plan week to week, season to season, no matter who they're playing? Absolutely not. Him and his coaching staff have very specific plans for every possession. They establish that stuff ahead of time. They try to focus on their relative strengths, and they admit or adjust when things aren't working sooner rather than later. And I think that sort of framework is generally successful, but not always, right? They take losses too. I think that's a lot like managing market or derivative risk. Managing risk without a clear plan is simply kind of hoping for the best, and good luck with that. So moving on, something I mentioned very briefly already, we're going to run through a brief market update to sort of set the stage. This visual that you're looking at now goes back to mid-June of 2022. So it's a 52-week relative performance with just a tiny bit of lead time because of compliance purposes. So you can see that the NASDAQ 100, or I will likely refer to it as NDX, is by far and away the performance leader. The S&P 500 is in the kind of silver position with a 20% gain over the past 52 weeks. The Dow and the Russell 2000, we're focused on US equities here, are fighting it out for the bronze. Both of those are higher by about 14%. If you looked year to date, the outperformance on the part of the NDX would be even greater, and the year-to-date performance for the Dow and RUT is barely positive. NASDAQ 100 bottomed late last year, and the other kind of major indices did so in September or early October of last year. Couple of quick stats when I was looking at leadership and laggards in 2023. Through last Thursday, 77 of the 101 components in the NASDAQ 100 are up on the year. That is fairly solid breadth. The top 10 performers of those 77 would be NVIDIA, Meta or Facebook, whatever you want to call it, Tesla, Palo Alto Networks, AMD. Those names have really smashed it in terms of performance, particularly NVIDIA and Meta. The bottom, like the drag on the index thus far has been Enphase Energy, Sirius Holdings, JD, Moderna, Walgreens. They got another bit of bad news today, Kraft Heinz. All of those names are part of the NASDAQ 100. They are all red or lower for the year. So my point here is that a rising tide, like the tendency to move higher, lifts most ships, so to speak. So NVIDIA has been the biggest beneficiary of what we'll call the AI boom in 2023. Facebook's recovered from their 2022 earnings disasters and the kind of money burn they've endured in the metaverse. Tesla has been doing what Tesla does, which is make big moves in both directions. Semiconductor companies have also performed very well this year. The more defensive elements of the NASDAQ 100, like pharma, names that crushed it in 2020 and 2021 are struggling. So I'm talking about the likes of Gilead. I mentioned Moderna a second ago. Some of the consumer staples like Dr. Pepper, Snapple, Kraft Heinz, and Walgreens struggling. More recently, there's been some interesting dynamics under the hood where rolling short-term correlation between measures like the VIX index and the overall equity market has been positive, like unusually positive. Now, I want to give that some context because it's jargon laden. The long-term correlation between forward volatility measures and a reference index like the S&P 500 or the NASDAQ 100 is close to a negative 0.75. Negative. Very strong negative correlation over the long term. As of last week, the 10-day correlation is a positive 0.61. That is highly, highly unusual. Also, here and now, you see higher dispersion and incredibly low implied correlations. More options jargon. I dislike the tendency to kind of sell fear or lean into that because it speaks to the reptilian part of our brains, and we're better served by our analytical brains when we're considering capital markets. But dynamics like that are unusual, and in this situation, ignorance is not bliss. So to the best of my recollection, it reminds me of late 2017, early 2018, where you had very low market vol. Indices were generally grinding higher in relatively small realized ranges, and there were some signs of froth following a pretty lengthy rally in 2017. So that one kind of ended in early February of 18 with what's become known as the Volpocalypse. The VIX index moved considerably higher on a day where the S&Ps were down about 4.5%. A couple of inverse levered VIX products imploded. Now, to be fair, those products behaved the way they were designed to, but I don't think many people understood what was behind the wrapper, the product wrapper. They looked at the performance over the past year and they said, I like what that looks like in terms of performance. I have absolutely no idea if a short-term market shock is around the corner. No idea. But the current dynamics from an options market standpoint and a vol market perspective are atypical. They're unusual. From a personal standpoint, I maybe wouldn't want to be long too many deltas, and I wouldn't want to be short an unusual amount of vega or gamma. Given the current backdrop, that is not a recommendation. It is simply my opinion, and it should be taken with the smallest grain of salt. Now that leads hopefully nicely into my next point about our brains and the market, because they're both influenced by the stories that we tell. When I take a position using an option or otherwise, it is based on some narrative that I've created in my mind. It might be influenced by data, but numbers alone are just digits. We need to fit them into an overall construct to make decisions, and that's where the stories come in. From my perspective, this is a powerful reality that's unique to humans. We have a desire to explain everything. I think that we function at a high level because we can run all sorts of the, if this happens, then I'll do that, and process that quickly throughout days. I don't think numbers alone motivate action. It's got to fit within a larger story that we manage internally. Now, the story this year has been an interesting one. There was huge pessimism at the end of 2022. There was much more rate hike uncertainty back then. Then there was the GPT AI explosion. You have this visual example of the Barron's headline with "This bull market has legs." In my experience, regularly asking yourself, what do I believe as it pertains to my investments, is a solid habit to maintain. So with that in mind, once you update your beliefs about the present, here and now, and the prospects for the future, understand that you can choose your own adventure if you understand the power and the flexibility of options. Again, I have worked in and around options for 20 plus years. This is what pays the bills for me, but I believe this very, very sincerely, and I use analogies like this to that end. So I think these books still exist, these choose your own adventure books. They're aimed at children. I remember them from when I was younger, but they speak to the power of options, which can be used to shape your investment path. If you're unfamiliar, don't sweat it. I'm going to explain. Years ago, and probably still now, there's a series of fun kids books called Choose Your Own Adventure. And you were presented choices at the end of chapters. And then you would make a choice, and that dictated where you picked up the story next. So there were all sorts of narratives that could unfold in like a single book. Think of it like alternative endings for your favorite movie or whatever, except you get to shape the outcome. That's the way that I look at options, in the sense that calls and puts are tools to shape investment paths, and they make you kind of the writer, director, and star, and who doesn't want that? So you can define outcomes. Now, this is dependent on your strategy over a given time frame, because options have expirations, and that at a very sort of fundamental base level is super empowering. You can legitimately change the narrative. Now, index options, which is where I focus most of my attention, I think in particular, they allow you to control the narrative at a much more macro level. You don't necessarily care about the same data points. Now, example there's no earnings date for the NASDAQ 100. There is, however, an earnings season. You don't run the exact same risks as you might with individual equity options, in the sense that an index is not going to zero, and individual equities can and periodically do go to zero. Indexes tend to have lower volatility, whether you're talking realized or implied, than most, but not all, individual equities. Those are a handful of the reasons that I gravitate toward indexed investing and index options to shape the path or the narrative as I look forward. Now, from an awareness standpoint, I'd like to call brief attention to the different notional exposures that are available in the what we call the NDX family or the NDX ecosystem. There's big NDX options where the notional value is right around 1.5 million. There's NQX, which is 1/5 the size of that big one, so 300,000. And then there's XND, which is 1/100th or 15,000 in notional exposure. And that option product is accessible to nearly any account size, the options on it. These options are all cash settled. There's no early exercise risk in the sense that they're European styled. So you don't have that dividend exposure like you have with some ETFs that track equities, that track indices. And they might get preferential tax treatment. That too can be a powerful motivator for many people that use index options. All right. So let's move on to another interesting dynamic in the current market. I sort of alluded to it a couple of minutes ago. It involves index option skew. Now, there's a variety of ways that you could measure index skew. Generally, it's the relationship over time between out-of-the-money calls and out-of-the-money puts relative to that at-the-money implied volatility for a given index. So I'm going to give you a real quick example. These are all 1 month or 30-day NDX options as of yesterday. At the money implied volatility was 17.5%. 5% out of the money calls were trading on a 16.3% implied volatility, slightly below the at the money. 5% out of the money puts were trading on a 20.5 volatility. Now, those are just numbers, right? The story is what gives that some shape. There's typically a much more pronounced difference in implied volatility levels between like those 5% out of the money calls and puts, with the puts having more of a implied vol difference than we currently see. Now that's primarily a function of the supply demand dynamic in the market. And that governs nearly everything in capital markets, the supply and demand. So there's been what's going on. There's unusually high demand for out of the money calls and relatively low demand for out of the money puts. And the market, the options market, the equities market, all these markets are constantly adjusting based on flows. And as a result, right now, the index skew in both the NASDAQ 100 and the S&P 500 is historically low. I mentioned it a bit earlier, but typically skew increases. Skew typically goes up when the market moves up and volatility falls. In general, the market has been moving up, but skew has been declining. I call your attention to the very bottom right-hand side of the visual, how skew collapsed lately. Now the visual shows Nation's SkewDex index, which compares the cost in volatility terms of 1 month at the money to 1 month out of the money options that are one standard deviation away from your at the money. So a quick shorthand way to figure out one standard deviation is to look at your 16 delta options. Now, you could also think of this in really basic terms as the relative cost of protection. Typically, there's more demand for downside protection than upside protection because most people are passive long the market. So you'll notice, or hopefully you'll notice, and I don't know if this highlights here, but in 2022, skew fell for most of the year. Now that was normal because the market was moving lower. Typically, when the market moves lower, skew moves lower. Then when the market rebounded in early 2023, here, skew moved up. That's normal. But what we've seen recently with a market kind of mostly holding up, down a little bit, and that collapse in skew is very unusual. So I take note when there's unusual activity like that. Another way to view this is that the cost of protection for a broad-based portfolio that resembles the NASDAQ 100 is cheap in historical terms. And again, I have to say this, but I mean it sincerely. That's not advice. It's simply an observation based on data in a historical context and explained at a very surface level. Okay. So, oops, I went the wrong way. Here we go. Okay. So then I asked myself, why is index skew collapsing? In other words, I'm kind of flushing out the narrative of the story that I'm telling myself. So with that in mind, I read something recently that struck me as simple but true, and I like simple truths. The point was that the price levels for indexes, so the S&P 500, the NASDAQ 100, those price levels and their direction of them is largely driven by sentiment. The sentiment now is so different than it was at this point last year when inflation was ripping higher. The war in Ukraine was much more front of mind. And thinking about the move we've seen in index levels, we're much higher than the start of the year. So again, this relationship between sentiment and price levels. Thinking also about the shift in options market skew, the demand for out of the money exposure as opposed to protection has shifted. People are saying, man, what if this continues? I need to be potentially more exposed, and they're less concerned about downside. I don't know what that says about the future, but that's how the dynamics have played out in the options marketplace. And then if you think about recent moves and sentiment more broadly, you have a narrative there, at least in my experience. And it makes more sense when you put all those things together. Now, I would argue that it's most clearly represented by the NASDAQ 100 because of the way that index is constructed. The index is absolutely weighted more heavily in information technology. But beyond that, I would argue that the global economy is also far more weighted towards IT than it was 10, 15, 20, 40 years ago, certainly. And I don't believe that that's likely to change in the near future. Could price levels at the index, could price levels for the NASDAQ 100 or S&Ps change? For sure, they're gonna. But the big picture narrative of the weighting and construction, I believe favors the NASDAQ 100 construction. So one example is the relative weight within the index for NVIDIA, which has been the belle of the ball in 2023. I've mentioned it already. It is part of both the S&P 500 and the NASDAQ 100. Now, what part of that recipe, that construct? S&P 500, NVIDIA makes up 2.69% of the index. NASDAQ 100, NVIDIA makes up 7.06% of the index. So the relative, that's just one example. The relative weights for Microsoft, Apple, Amazon, Meta, and Tesla are also substantially higher in the NASDAQ 100. The NASDAQ 100 doesn't have financials, which have underperformed dramatically in 2023. There's also not energy in the NASDAQ 100 in its pure form, like Exxon or something, and that too has lagged. I'm going to write something that'll come out either later this week or next week, kind of with specific sector attribution for performance year to date. If you follow or sign up for the stuff I write, you will see that before long. So we are going to bump up against time, and I have a fair bit more, but I'm gonna focus on the fact that I'm gonna focus on this IT, on this information technology point. I'm gonna remain on topic. The market leadership thus far this year has been best reflected by the technology ETF, and I show a 5-year chart, so it goes back to 2018 on the right-hand side. The black with the bar chart. And in total return terms, so that includes dividends, that ETF recently made new all-time highs. So it goes back to 2018. And there's what I've highlighted are 3 different, what I would consider meaningful bull market runs. It's obviously not all encompassing, but it includes far more than the past 2 years. There is this 14-month run up when I'm moving from left to right on the right-hand visual. So there's a 14-month run up late in 2018 following a sentiment shift. We had concerns about emerging market growth, and there was a renminbi or yuan Chinese devaluation that occurred at that point in time. So a 78, 79% move in 14 months here. Then off the very acute COVID lows, so we're talking mid-March of 2020, there was a 21-month bull run. Granted, pullbacks. There were absolutely meaningful pullbacks along the way, but before this bigger picture one. So I'm calling that 21 months and 151% move in this technology ETF. Now, more recently, I'm going to call it a 9-month bull run. The from lows to recent highs, the technology ETF is up about 51%. So what do I make of that? I'm not saying that this is bound to continue. I'm not saying that it won't, but I am saying in terms of length, it's not necessarily crazy to think that it could. There were significant drawdowns in the 2020 and the 2018 runs. But if you take the average of the two, they lasted on average about 17.5 months. The problem there is that you have 2 data points as opposed to a much bigger sample size. And that alone, I think, warrants caution. The visual on the left-hand side breaks down the weightings of the top constituent holdings in this ETF product. So you see Microsoft plays a very big role. Apple plays a very big role. NVIDIA, much smaller. Then you have things like Broadcom, Cisco, Salesforce, AMD, right? Now, my point about those weightings is that these weightings were, skews heavily in Microsoft, Apple, is much closer to NDX weightings as opposed to S&P 500 weightings. And so the construction of your portfolio matters, and big picture, not all indexes are the same, right? There are significant differences if you track the performance of the S&P 500 relative to the Russell 2000 or the Dow or the NASDAQ 100, right? I'm going to go back to this in the last 2 minutes and just say, I had a conversation with a friend and a very smart person 2 weeks ago that sort of shaped my opinion on this. Now, they're not in capital markets, but I was just bouncing off ideas off them. And I tried to get them to articulate what they saw as the difference between like the NASDAQ 100 and the S&P 500 or other US indices. And the answer, what came back is what surprised me. It was effectively nothing. I see no difference between them. And so that's informed some of the presentations that I'm giving more recently. It's informing the points that I'm making here this afternoon, and it will continue to inform some of the stuff that I write about. I am bumping right up against time, and I would like to take the last minute to just reiterate my sort of Bill Belichick coaching, have a plan belief, because I believe it very strongly. I think the alternative to having a plan can be really costly. And I think it's advisable to establish a plan and stick to it. Without a plan, we're going to bargain with ourselves, and we're more likely to make emotional decisions as opposed to logical one. And there's a time and a place for emotion. When the Cubs won the World Series, my decisions were driven by emotions. When my son has a little league game, I am driven by emotions. But when some of my favorite musical acts are in town, my decisions are driven by emotions. but the risks are contained in those scenarios. If I'm making big financial important decisions, I do not want them driven by emotion. I want them made logically. I want the big picture goals in mind, and I want flexibility. I want choices, and I want to know that I'm not going to be wiped out if there's a big reversal. And so, in my opinion, essentially what I'm saying is I want index exposure and I want options to manage that broad exposure. And I like the flexibility of index options. If this stuff is new to you, there is plenty to learn. Come back and listen to something else that I do. You can email the group that I'm part of at indexoptions@nasdaq.com. You could learn more about the NASDAQ 100 ecosystem if you're interested in foreign currency options, information there. But I always have more to talk about. And this is a perfect example because I didn't get to go through everything, but we are time constrained. I appreciate all of your time this afternoon. And Charlotte, I give it back to you right on the bottom of the hour.
Fantastic. Thank you so much, Kevin. That was really a wonderful presentation. It's such a pleasure to have you on the show.
Thank you.
Of course. I did put that email address, the indexoptions@nasdaq.com. For those of you in our live chat, if you have any questions, you can feel free to reach out there to find out some more information. Alrighty, everyone. Thanks so much for tuning in today. We do still have some more in store for you, so be sure to stay tuned. And then, of course, we have 2 more full days stocked up for you tomorrow and Thursday. I hope everyone has a wonderful rest of your day. Take care.